And I think a lot of people are hanging on to hope that there's going to be some dramatic change in interest rates, but the Fed's not indicating that that is the case. Most of the smart money at this point is betting that interest rates are going to stay pretty flat this year.
Hey, what's going on, everybody? Welcome back to the Land Development Podcast. I'm your host, Ryan Glick. We have an industry news episode for you today. That's where we pull up a few different headlines and we talk about what it means for the land development industry. And joining me, as always, on these is Charles Covey. And if this is your first time joining us, we also have interview style shows. So sometimes when you tune in, you're going to hear an interview style show where we have on someone associated with the land development industry and we dig into some topics that are of interest to them. So you'll be hearing one of those tomorrow when you tune back in tomorrow. So with that said, we are going to go ahead and jump right into today's articles and get into the first one here, which comes to us from Realtor.com. And this is actually a review of their May 2025 monthly housing market trends report. So a quick summary from this article and from that report. Active listings jumped 31.5% year over year, the 19th consecutive month of gains. Inventory is now over 1 million homes for sale, but still about 14% below pre-pandemic levels. Pending listings increased 20.8% year over year, though the number of homes under contract fell 2.5%, reflecting rate-sensitive buyer behavior. New listings rose 7.2% compared to May 2024. Homes spent a median of 51 days on the market, 6 days longer than last May, and close to pre-pandemic norms. The national median list price held steady at $440,000. Price per square foot rose 0.6% year over year. 19.1% of active listings had a price reduction, the highest share for May since at least 2016. And then inventory grew across all regions. In the West, it grew by 40.7%. South, 32.9%, Midwest 22.9%, and the Northeast 19%. And then digging into a few specific cities, looking at Texas here first, in Austin, active listings were up 26.5% year over year and are 69% above pre-pandemic levels. Median price dropped 5%, and homes are sitting 3 days longer. In DFW, inventory jumped 44.8% and is 55.5% above pre-pandemic norms. Median price slipped 1.2%, and days on market rose by 7. In Houston, new construction accounts for 35.1% of listings, one of the highest shares among major metros. And then among major U.S. metros, Denver, D.C., Las Vegas, San Diego, and Seattle have the highest inventory above pre-pandemic levels. The Midwest and Northeast continue to lag behind in inventory recovery, remaining well below 2017 to 2019 levels. And finally, time on market increased across all regions, with the South and West seeing the largest jumps. What are your thoughts on this, Charles?
We've seen this building. It's been building over a number of months. The numbers continue. We've been keeping everybody abreast of the information, so we continue to bring what I think is pretty good data, pretty current data. So we've been seeing it happen. We wondered if maybe it was a pre-spring build-up, and then a bunch of inventory was going to clear out in spring and early summer. That remains to be seen. We don't know for sure. I think that certainly there is some inventory moving, but I think it's reasonable to assume at this point it's not as much as we would have hoped or expected.
Yeah.
So, yeah, it's a problem. And I think a lot of people are hanging on to hope that there's going to be some dramatic change in interest rates, but the Fed's not indicating that that is the case. In fact, I think most of the smart money at this point is betting that interest rates are going to stay pretty flat this year. So, yeah, if you're waiting on some big thing to change, it doesn't look like there's going to be any big levers being pulled here. So I would expect over the next 6 months, we're going to continue to see this trend, more of the same. So my guess is, and we'll probably want to dig into this, Ryan, but my guess is that home builders are seeing this, and that, they can't have inventory increasing at this rate and continue to build at the same rate. So I'm sure that new starts are dropping accordingly, unless there's some massive movement that's happening in May and June that we just don't have access to the data yet. So we'll see how that plays out in July. I'm not expecting that to be any extreme movement. So new starts will slow down. and this will probably normalize, uh, toward the end of the summer or the fall. But the only way to do that is to just, to drop production pretty dramatically. What do you see it? How do you see it, Ryan?
Yeah, well, one thing I was going to mention, I didn't put it in the slides, but I saw, I think it was yesterday, from when we're recording this, that President Trump made a post and talked about how there's a deal in place. They're just finalizing with China. And so I haven't really
Yeah.
noticed much talk about tariffs and how they're causing any major impacts. I know there's probably going to be some sort of catch up, but I don't know that that is something people are worrying about as much, because it seems like most of the negotiations and stuff have taken place with the countries that they need to take place with. And so now it's more
Right.
of a focus on interest rates, like you already mentioned.
And the other part of this, Ryan, that we just don't know how to predict. And as an economist, this is a tough one to put on a graph, on a supply and demand graph. It's possible that just the sentiment is a major driver. It's not that people don't have the money. It's not that the interest rates are too high to be tolerable. It's not any of those things. It's just that people don't want to make a move in a time of uncertainty. And you can't deny it's been a time of uncertainty for the, probably since Trump took office. There's been a lot of uncertainty. Now, I think we've been saying from the beginning that uncertainty uh, was probably not going to be wildly problematic. It was going to sort itself out, and it has done that consistently. So I feel like we were correct there. As the uncertainty sorts itself out, is that the change? Is it as simple as that? Is that all the change that was necessary, or do we have actual, real underlying market factors that are going to be driving this, not just sentiment? So that's the question that I just simply don't have an answer for. Do you have any thoughts on that?
Yeah, I don't know either. I don't know. I do think there's a big part of this is what you're talking about there with sentiment. I do think that, I mean, we see it in all areas of people's lives, right? I mean, people who, depending on whether you're in an echo chamber or like where consumers are at, what kind of news they're listening to, I mean, they could be 100% doom and gloom because there has been real uncertainty, but they could be like way down in the dumps about never being able to get a place. But I think there is an affordability issue as well for some of the first timers. And the first timers are going to have problems until we start giving them a better product that is more affordable, or until people who are holding on to their homes and aren't going to sell because they don't want to go to a higher interest rate, until they can actually sell their homes and open those homes up for the first time home buyers. So there's
Also a factor for sure.
yeah. So I don't know. I'm with you. I mean, you're a better economics mind than me, but I don't really know how that's going to play out. But I do think you're right. I think that sentiment has to be playing into this on top of everything else.
Mm-hmm. The part that we all want to know is our economy broken? Do we have these big chinks in the armor that are causing this to happen, and now we've got major issues that are going to come up, or is it really just, hey, we've got a sentiment issue that is more significant than maybe we've seen in the past driving this? So again, we'll bring the data over the next couple of months, but we want to really be watching this closely to see what May and June do.
Yeah, and I guess I'll add one other thing here. One other thought that's been on my mind too is that inflation is still a real big thing. We see the government passing their budget, which is going to add to the deficit. Um,
I think certainly going to affect inflation.
Yeah, and so we're not solving that problem at the root. And so where does that end? Because that's just going to continue to exacerbate certain problems. And I know a lot of people like to turn a blind eye to that and say, "Hey, it's what we've been doing over the last however many years, so let's just keep doing it. Let's keep passing this budget that is in excess of what we actually produce." That's a problem, and it's going to impact this industry definitely.
Well, all that spending, all that money goes into the economy, and that's an inflationary problem. So
Correct.
there's some benefits, right? Some stimulating benefits of it going into the economy, but also some inflationary detriment.
Correct. All right, well, let's go ahead and move on to our next segment, which is from the comments. So, as I pulled this one in here, it was kind of funny because this is a little bit of inception, comment inception here, because this comment comes to us from a video that I posted of Charles, you replying to another comment. So, Anyway, it's on the topic.
This is layers on layers. I love it.
Yes, yes. And this one is related to parking again, and I thought it was a good comment, so I put it in here. So this one comes to us from Cody Main 2 from TikTok, and he says, "Please God deliver us from excessive parking lots and unnecessary highways. Bring back town squares that are more natural and organic throughout history. More public transit to encourage less cars on the road."
Absolutely.
Yes, well said.
We're with you, Cody. We agree.
Yeah, I do like the town square is something that I do think is drastically missing. I know small town Iowa here where I'm at, a lot of the county seats, they all have the town square and they all revolve around the courthouse, right? But you have that town square with all the, you can walk it and there's little shops and all that.
Yep.
You just
Yep.
you just don't necessarily see that in new developments.
It's hard to recreate on a city level unless the city's behind it, and they're just not
Yeah.
really in the business of being visionaries and placemakers, and so they don't
Yeah.
think about it that way. They're just following along these kind of general rules, and when people bring them projects, they try to make the projects fit the rules, and so that's not the planning and placemaking that we need. So the only time you see that is when somebody's got both the balls and the financing to go buy 1,000 acres and do this themselves and do all the components, all the different types of multifamily and single family and commercial, and this takes 20 years for them to put together. And it's only the developer that's got the wherewithal to do that, because it's just really tough for a city to execute. It's just not their forte.
Yeah, it's like so my parents live down in the Villages in Florida, and they have
Oh yeah,
it's massive, right? And they have um, all these different town squares where they
yep,
have activities, and then they have all the shops and everything like that. And in
yep,
order to make it work, the town squares are open to the public, not just people that live in the villages. And
certainly.
I feel like they've done a good job with that. They're always busy, and they seem to do pretty well. But I mean, that's this massive. Those developments are massive.
Yeah, yeah, it is. And I haven't studied that enough to know, but how many developers were involved? I mean, it's thousands of acres. I assume if somebody started it, we should probably, this would be a cool case study to do sometime
It would.
about some of
Yeah.
these great places where somebody's done what we call placemaking, and really truly created something that has a draw to it.
Yeah. Yeah. So all you listening in, if you have any good case studies you think we should dig into, definitely send them our way. Would love to use one of those to dig in. This episode of the Land Development Podcast is brought to you by Groove. Groove's built around a map, but that map connects everything. You can prospect land, find ownership information, and see key parcel data right from the start. Then, when you talk to a landowner, add a note, upload documents, or drop in a photo, all tied to that parcel. Nothing gets lost in the shuffle. You can even bookmark parcels and organize them into folders to keep your research clean and easy to come back to. Once you're ready to turn a parcel or a few parcels into a deal, Groove's deal management tools let you track everything visually on the same map. No new files, no exporting data. It all lives in one place. Start your free trial today at letsgroove.com/signup. That's letsgroov.com/signup. All right, let's get back to the show. All right, let's keep moving along here. So we're heading into article number 2. This one comes to us from Resi Club. So what we're going to go through now is actually some survey results from real estate investors. In this survey, there were 239 single-family investors and landlords that completed the survey. So I'm going to go through a quick summary, and then there's 3 graphs, I think 3 or 4 graphs that we'll look at as well. So reading from the summary from this article, 65% of investors say the hardest part of buying is finding cash flowing deals. That number jumps to 78% among investors in the Western United States. 45% plan to expand their portfolios in the near term. 50% are willing to accept interest rates up to 7% on their next purchase. 58% of respondents manage their properties themselves rather than hiring a third-party manager. 20% primarily search for off-market deals before anything listed. Over 70% say Zillow is either very or somewhat helpful in their property search. And then high interest rates, slow rent growth, and high prices are making it harder to find cash positive rental opportunities. So going into the first chart here. So the headline for this chart is how real estate investors say they plan to manage their portfolios in the near term. So for those of you listening in that don't see the graph, there's three different categories. There's whether they're going to grow their portfolio, whether they're going to maintain it, or whether they're going to exit some properties in their portfolio. Across the United States, as we already mentioned, so 45% say they plan to grow, 48% say they plan to maintain, and then about 6.5% say they plan to exit. The Midwest is where it looks like the largest plan to grow is, and then the West is the largest to maintain, and then it looks like the Southwest, or I'm sorry, it looks like the Southeast is the largest exit here at 9.5%. Does that surprise you at all at
Well,
this, Charles?
this is not surprising on the Western U.S. I mean, California is just, it's very tough. The prices are higher than the rents will support from a debt coverage standpoint. You throw in some high interest rates, it just the deals don't work. The high exit in the Southeast versus the Southwest, that one I don't know what the correlation is there. I just don't know if there's enough. I don't know if there's enough data for that to be statistically significant.
Yeah.
But maybe possible. I think generally Southwest and Southeast are still very very strong markets. But the challenge really is the interest rate and your property value to rent. And that property value to rent on the West Coast is just very skewed. You can't charge enough rent to make it make sense. So it's tough.
All right, next chart here. The title of it is the highest mortgage rates real estate investors say they would accept on their next purchase. This one was kind of interesting. So, of the respondents, 100% of them, of course, said that they would accept a 4% or lower interest rate. 96% said they would accept 4.5% rate. 91% of them said they would accept a 5% rate. 82% said they would accept a 5.5% rate. And then 72% said they would accept a 6% rate. 60% said they would accept a 6.5% rate. And then 50% said they would accept a 7% rate. And then only 18% said they would accept a 7.5% or higher rate.
So it's a pretty noticeable tipping point there at kind of that between 6 and 7. That seems to be where the mass is. And that's not shocking, but we're not there.
Right.
So that's a problem. The majority of this says that the rate that most people want is not a rate that they can get. Because I think that 7 and higher is probably most of what's out there.
Right. Which is that smaller percentage. All right. Next one here. The most frustrating part of the buying process, according to real estate investors. The biggest one in all of this is finding deals that cash flow. That's kind of generic. I guess it's just they're having trouble finding deals, and I'm sure that has to do with a lot of different things. The rates, they just can't find deals that'll pencil, I suppose. The second highest part that's most frustrating is competing with other buyers and investors. Of course, that's part of the game. And then the third one is running the numbers or analyzing deals. So I'm not sure if that means that it's frustrating to try to run the numbers and analyze deals. Maybe they're not, the respondents aren't good at that. I'm not sure. And then the last one here I'll mention is just getting financing or approval. So we know that we've had somebody on recently who, their financing is only in the single family residential space, but financing is tight. Mm-hmm. It's still tight. So that's not surprising. All right. Well, that is all for this particular article. Anything else you want to add on that before we go into the last article?
No, it's just interesting data. Nothing really shocking there.
Yep. Agree. All right. Last one here. Article number 3 comes to us from the New York Post. Headline reads, office space is now being raised or converted faster than it's being built for the first time in 25 years. So a quick summary from this article. For the first time in 25 years, more office space is being demolished or converted than newly built. By the end of 2025, 23.3 million square feet will be removed compared to just 12.7 million square feet of new office completions. High vacancy rates, about 19%, and a shift toward remote hybrid work are behind this transformation. Eliminating unused, obsolete offices is helping stabilize rents, especially in desirable Class A properties. Office to residential conversions are booming, 85 million square feet in the pipeline, with New York City expected to convert enough space to create over 8,000 new apartments. One thing I'm going to note on that bullet point there is that episode number 88 that comes out tomorrow on June 17th is with Scott Harris, who is a broker out of New York City. We actually touch on that topic quite a bit. So you'll want to tune in tomorrow. He talks about all the office to rent conversions that are happening out there right now. Super interesting. And then the last couple bullets here. Major conversion projects include 25 Water Street, 1 Wall Street, 55 Broad, and 5 Times Square. And then experts say this trend supports housing supply growth and may help contain apartment rents. Thoughts on this, Charles?
The conversions are really interesting, and New York doesn't have a choice. They've got to be able to convert some of these. There's just the demand is not there. We're continuing to see demand change, right? So it's not that people don't need offices anymore, but they need them in a different way and in different locations. So it's a have and have not scenario. There are segments of the Dallas Fort Worth Metroplex that office is leasing as fast as they can build it. And we've talked about this before. These are the live, work, play environments. These are the places where people are gravitating to. They want to be there. And then you've got the areas where it's an office monoculture, low-rise office on a periphery of a city with nothing else around, and nobody wants to be there. And those are toast. So this is kind of a broad brush article saying a lot of very general statements that you have to really, like almost all the data that we see, we have to really look in and see like what are the nuance that we're missing in this statement. So we're going to continue to see a very significant shift in that market. If your primary business was building new office, it's probably a pretty tough time for you.
Yeah, and not to spoil the episode tomorrow, but I mean, Scott does mention that of these office to resi conversions, it's such a tiny number
Absolutely.
of units compared to the housing needs that they have. So I mean, it's a thing, but it's not necessarily the thing that's going to solve our housing problems.
Right. Well, and the challenge here, the well-located office that would be a good residential conversion is still fine for an office. It's the poorly located office that doesn't work for residential, so the conversion is not really an option. There's just such a short list of, and there are some like downtown Dallas core was an office monoculture for decades, and there are some opportunities for somewhere like that where there is some additional residential already around. It's not as much of a monoculture as it used to be, but there's definitely less office demand there. Now you go to Uptown, 2 miles north, there's super high office demand, so it's kind of crazy. But they can convert some of these low demand office into residential, but it's such a short list of the ones that actually work for that. So it's just there's not that many of these office to residential deals that you can make work. It's very challenging.
All right, well that's all that we have for this episode. Any final thoughts, Charles, before we wrap up?
It's good. I like it.
All right, guys. Well, that is all for this episode. If you are not subscribed already, click that button. Love to have you come back for additional episodes like tomorrow's episode with Scott Harris and additional industry news that we'll be doing here in a couple of weeks. But otherwise, that's all for today, and we will talk to you all tomorrow.